When we analyze the foreign exchange market from a distance, long-term trends appear to be dictated by large institutional forces and macroeconomic policy. But zooming into tick-by-tick data reveals that these macroscopic rules lose their predictive power. The market begins to exhibit statistical behaviors that standard macro models cannot account for. This histogram maps high-frequency exchange rate changes. Notice how the actual data points extend far beyond the boundaries of the superimposed bell curve. These are fat tails. Gaussian models treat these extreme short-term rate swings as statistical impossibilities. In reality, they occur with high frequency. These statistical anomalies and long autocorrelations emerge as the deterministic result of microscopic trader feedback loops. To understand macroscopic market complexity, we must mathematically model the collective, tick-by-tick behaviors of individual traders. This is the execution level of the foreign exchange market. At this scale, traders constantly predict future exchange rates by tracking short-term moving averages. These execution strategies are bounded by a specific window of recent price action. Researchers Takayuki Mizuno and Misako Takayasu analyzed 13 years of tick-by-tick yen-dollar market data to find the mathematical signature of this behavior. By walking through their derivation, we can build a self-modulating autoregressive model that isolates the true market signal from this reactive noise. This jagged line represents the raw price at time t+1. We separate this into a smoothed moving average curve, P of t, and an erratic residual noise line, epsilon of t. The foundational equation integrates them. T+1 equals P of t plus epsilon of t. To calculate that average, the model introduces a weight factor, W of k, determining how much past prices influence the calculation. These weights must be tuned so that the autocorrelation on the noise term, epsilon of t, is reduced to nearly zero. Data indicates that to achieve zero correlation, the weight factors must decay exponentially, with a characteristic time of roughly a few minutes. This exponential decay suggests that the most relevant market data for participants is concentrated within a window of just a few minutes, aligning the model's structure with the short-term focus of high-frequency traders. While this isolates uncorrelated noise, the absolute value of that noise contains a secondary structural characteristic. Let's focus on that residual noise line, epsilon of t. Although the raw noise has zero correlation, its absolute value exhibits a long autocorrelation. We can model this by extracting the logarithm of the absolute value for time t+1. An autoregressive stochastic process is then used to model this volatility trace. This requires new weight factors, W sub epsilon of k, specifically for the logarithmic absolute value. These weights decay according to a specific power law, k to the negative 1.1, matching the same characteristic time of a few minutes seen in the price average. Market volatility possesses its own short-term memory, providing the basis for a fully self-modulating system. The complete self-modulation model combines these branches. The price equation, P of t+1 equals P of t plus epsilon of t multiplied by alpha of t. The noise equation, epsilon of t+1 equals epsilon of t multiplied by factor b of t plus additive term f of t. The multiplicative factor b of t acts as the critical self-modulation variable, representing the market's response to its own past rates. The additive term f of t represents entirely independent external factors. This is the entry point for macroeconomic events, such as central bank interventions, data releases, or policy rumors. These external events are injected as Gaussian noise, which the internal B of t feedback loop then amplifies or dampens. Both price and volatility are mathematically governed by their own historical traces, creating an engine of market mechanics. Transitioning to empirical validation requires simulating these self-modulation equations. We run the equations while allowing the multiplicative factor B of t to fluctuate based on the observed probability density in the real market. This chart compares time lag against autocorrelation, overlaying our simulation data onto the 13-year yen-dollar dataset. The simulation data points, shown as open diamonds, nearly perfectly overlap with the real market data points, the solid diamonds. Above these points is the bold dashed theoretical trend line. The slope of this line defines the power law distribution, with a beta of -0.25. The macroscopic power law of the foreign exchange market is the direct mathematical consequence of the multiplicative factor B of t fluctuating over a moving average. This provides a clear principle for quantitative finance. In modeling, isolating residue terms to achieve independence reveals the underlying structure of otherwise chaotic systems. The extreme fat tails and historical unpredictability of foreign exchange markets are highly structured, deterministic phenomena. The macroscopic complexity of global currencies emerges from the collective response of individual traders to the last few minutes of price action.